Hello folks, welcome back. This is March 2nd, 2021's daily log entry for the ICT Mentorship. Alright, so I want to talk a little bit about the dollar index and the euro dollar in a little bit more detail than that of the British pound. And then I'll mention the S&P at the end. So we're looking at the dollar index as a daily chart. You can see we have the mean threshold of this last up close candle, which is a bearish order block that's projected in this time. Then we have that rejection block I drew your attention to before we traded down through it and rejected. So right away, I want you to notice that we have, again, not done a whole lot. January low, February high, nothing terribly exciting. So we're still inside this range. Nothing has happened, even though there's been trades. So don't get excited about missed moves or being concerned about, oh no, it's moving without me. Nothing's going on yet. It's still in a range. So these two reference points here and these lines, this is what I'm going to refer to on the lower time frame charts. Okay. So here's that daily bearish order block mean threshold and the rejection block on the daily chart, okay? So now we're looking at the dollar index. This is that market maker buy model. This is the original consolidation. Okay, so just look at what we've done here. And this is kind of like a, I guess it's a knack or an experience thing where your eye just gets used to seeing it and finding it. And it's, I guess it's like the fair value gap. You know, when you first are introduced to it, you're like, what am I looking at? And then all of a sudden you start seeing them everywhere. This is just a matter of looking at where you can see a clear consolidation. And it doesn't always look like a perfect box, okay? What I usually look for is some key high. Okay, what makes this a key high? Well, it turned and traded a lot lower and broke a significant low. So in here, I'm going to frame out where a consolidation would be. And that's what I'm delineating here. And the return to the consolidation. So a market maker buy model is a consolidation, a break lower, return back to consolidation. That doesn't necessarily have to happen. Not all of them will have that. So through your time in this mentorship, you will see me refer to market maker buy models and sell models that do not have the return to the consolidation. Okay, it doesn't need to do that, but we expect it to. So it does so here, then it trades off again from distribution, which is that high, trades one more time up into distribution again, sells off into smart money reversal. Then the market will rally, come back down, provide a low risk buy, reaccumulate. It's picking up more buy orders that match up with the old areas of selling. And then it rallies up and runs out the original consolidation high where there's buy side liquidity. And then we have 30 pips stop run above. And we run just a little bit above that, but 30 pips is a good ballpark measurement. And also trading up into that mean threshold. Okay, so a lot of things converging here. Now, this was where I said we're basically done. It can go up a little bit more, but this is the remaining portion of it. And then we get this slide lower after it goes into the mean threshold and sweeps 30 pips above the original consolidation. All of this in here, you're going to learn more about that pattern throughout this mentorship. It's not taught in any one particular video. I can't teach it all in one particular video. Okay, you're going to see this layering effect over time and how all these things work together. In short, I want you to think about how you as a trader imagine taking signals. In other words, what makes the trade ideas seem significant enough for you to consider taking a trade? Some of you are just really into the optimal trade entry, and that's fine. Others, you like your order block. Now you have the fair value gap. Some of you now have institutional order flow. You have breakers, mitigation blocks, and things of that nature. I want you to think about how the market is predisposed to go higher when we get down to this level here, and then how we framed out ideal entry points here that led to a run above this old high. The easiest way for me to make the most significant turning points are defined with my market maker buy model and sell model. Now this is a buy model because you're buying at a low risk level down here with smart money. You won't always get this entry. This is where you've been doing it for a number of years after becoming a charter member. This here, here, or here is about what you're going to be striving for by the time you're a charter member. Now, you may get to that point where you can trade these points here in your mind, in paper trades, demo trades, not live trading, okay? It's important that you're reminded of that. But we're focusing here. So if it was going to reject and reverse down here relative to that daily rejection block, that's what this level is here. If it's going to go up, where is it going to go? Here. So everything from this point here till we get to this price level should be a buy. So it keeps you on bias. Bias being bullish. Okay. We don't trade dollar. We use it for a barometer. So it's telling us that foreign currency should be going lower. So if we get buys here on dollar, that should translate into sells for euro dollar and cable, or British pound versus US dollar. Until we run above this high. How high? Well, if we went above a 10 pips, does it get to that mean threshold? No. Does it get to the order block? Probably. If we go 20 pips up, does it get to the mean threshold? No. Does it go into the order block? Yes. What if it goes 30 pips above it? Well, it goes to the mean threshold, half of the order block on the daily chart. And we also have this run from here, consolidated, a measured move idea, which lines up with that mean threshold as well. And measured moves are just simply this low to this high added to this low projected up. It's essentially that level here. The easiest way of saying it is this is a classic bull flag where when your institutional order flow is bullish, then they will work. But many times you're going to see bull flags form just because they may fool you into thinking they're there when it's opposing the underlying institutional order flow. So it's important you understand that we're outlining the logic that gets behind why these markets move to where they go. Okay. So you were framed on how and what would constitute a smart money reversal down here with the logic of the rejection block. And we framed out all these reference points here and how they line up over here and targeting the buy side liquidity over here. If you just took a run to this initial run here and that was it, that's all you ever did, and didn't participate in any portion of this move here, is that a failure? No. Don't be tricked and lulled into thinking that you have to get this exit, because if you buy down here or here or there and you get out just at that high or just below it, it doesn't even need to break that. If that happens, you have a model that works, and who cares how many pips you take out of it? If you're consistently able to find this move a couple times a month, well, who would be upset about that? No one should be. Okay, but you're going to learn more about this. I just want to bring it to your attention now, because you're going to hear a lot about this throughout the months ahead, and a lot when you're in a charter membership. Now here's the 15-minute time frame. You're probably thinking, this feels like a midweek review. Midweek review is going to be real short when it comes to reviewing. And again, we're going to start pouring into lessons. So I'm giving you some of that now. So it's not just, here's what happened. I'm giving you logic and the reasons why some of these things panned out as the way they did. Again, smart money reversal on that Thursday last week. All of the key buy points at reaccumulation. The old high. This level here is that old original consolidation high, and it trades up into and breaks down. We have a small little fair value gap there, which it trades up into right there, and it's also institutional order flow entry drill. We also have a breaker in here. Okay, not this one. Even though we can go down to a 1 minute chart and such and look at that and say, oh, well, you know, that's a breaker too. Why not use that one? Because we had the consolidation here. See these relative equal highs here? So the low prior to that being ran out is here. So don't try to get too greedy with thinking you want to get an entry up there. You don't need that. Okay, you don't need to touch that breaker. And here's enough for the logic. And it's just below the SIBI here. Sell side imbalance, buy side inefficiency, or fair value gap. Why did I call it a fair value gap the first time? This is a pop quiz question. Why did I first call this a fair value gap, not a SIBI? I eventually called it a SIBI, but why did I first call it a fair value gap? Because this right here is a larger inefficiency on the downside. So that's a sell side imbalance, buy side inefficiency, and that's a fair value gap. Both are the same. This is just a smaller range versus something like this. Moving into the 15-minute time frame, I gave you a what do you see exercise on my community tab today on YouTube. And these relative equal lows I kept out of the picture, okay, because I wanted you all to go to your charts and see what it was aiming for. You should be looking for these in your charts because that's where sell side liquidity resides, and if it's dropping, it's going to want to go into that. We do have a lower one here. It may be a level that we may want to sweep overnight and then back up into here. Here's that breaker, these consecutive down close candles prior to these relative equal highs being taken out. It could have traded up to here, but I'm teaching you the logic that my mind goes to this first because the relative equal highs, that is a PD array. While this is a short-term high that gets ran out, yes, I will admit that's true. But if we have relative equal highs prior to something like that forming, I'm going to look at the low prior to that. So if we break down through, this is the level that's going to be most important to me. And you can see the market trades up into this sell side imbalance, buy side inefficiency, or fair value gap. And it does so in New York with institutional order flow entry drill, and then sells off, comes back up into mitigation here, sells off again, and attacks the sell side liquidity there and reaches into it at London close at noontime. If you look at the daily range in this regard, it's the open, rallies up, creates the high of the day, continuation in New York, makes the low of the day in London close. So again, this framing is a scalper's daily range. So we're looking at midnight to noon New York time. We're going to teach more about time, but for now and for a couple months, we're going to be working with this range here. Okay, and then we'll evolve into true day. All right, and finally, the daily log entry 5-minute chart for the dollar index. You can see we run up into the London open kill zone, creating the high of the day. After it completes the market maker buy model, it creates the high of the day. Breaks down, trades back up into the imbalance here for institutional order flow entry drill. New York session. Sells off. Fair value gap here. 1, 2. What happens if it goes up in here and moves away? It's done, right? We don't use this fair value gap. No. Perfect example. Okay. It sells off. Look at the big move occurring in London close. The big moves occurring after the original setup forms in New York in continuation of what formed and what bias was formed in London, bearish. Heavy selling in London close. Goes a little bit lower, but we're not worried about that if you're working with intraday data. How do you find high probability setups in short-term scalps or intraday swing trading? Midnight to noon. Euro dollar. Here's our fair value gap I mentioned that would likely be traded up into. Here's the mean threshold of the bearish order block here, extended out in time. So there's your two levels in here that you'll see on the lower time frames. In this box here, I want you to see where this is in relationship to the daily chart, because I'm going to show you the market maker sell model here. Doesn't look like it here, especially for those that are new and don't know exactly what that is yet. But I'm actually teaching it to you right now. So the original consolidation is in the daily chart here, but we don't see it in the daily chart. But the logic behind it is there. So remember, there's a bullish order block, traded down into here. And I said, okay, we're going to look to see if it wants to trade higher. If it trades above here, we have a buy side liquidity pool here, and it'll use that to springboard into the fair value gap up here. Well, we traded through it here and ran it right up into the fair value gap. Since then, traded softer and back below this low into a discount array in the form of a bullish order block mean threshold. Half of this down close candle is the mean threshold. That's a sensitive price level. You'll learn about that as you get more into the mentorship, and if I'm not mistaken, I covered a lot in month 4. Now here is the market maker sell model, which is the opposite of what we saw in the dollar index with its buy model. This is a sell model. We have an original consolidation. It runs up out of the consolidation, comes back down into it. Okay, this does not have to happen, but if it happens, great. If it doesn't, it doesn't matter. But this is a reaccumulation. What is reaccumulation? So what's happening is smart money's buying down here, and then they're buying it in here, and then it drops back down, and they buy more of it here with all the things that I talked about. Go back and look at all the other notes and annotations. All this is stripping it away to the logic, but I was giving you the very specific price points and PD arrays that line up with these ideas. Okay, this is theory. I gave you the fine details day by day. Then it runs up into the fair value gap on the daily chart. That's the smart money reversal. This is where smart money or the interbank traders are offloading their longs and shorting heavily. They get to this point, the algorithm stays up there. Notice what's going on? It's staying up in there. Is this buying and selling creating this perfect little area of consolidation? Like they're all working in concert to create this opportunity for the pause up here for smart money to assume short positions and offload their longs. Think about this, folks. Think. This is all design. And the market trades down. Oh, you're talking in hindsight, Michael. Remember, I said this is going to be the area where it's going to trade to. So if I give you more logic, don't discount it. Okay, I'm telling you what goes on behind the scenes. So the market creates a smart money reversal here. Again, you won't always see these price points, but you're seeing that I can call where they're going to go and why it would be important for a level to trade to there. And then you introduce all this logic here, and then it starts to come together like a jigsaw puzzle. The market sells off. We have another level of distribution, which is the bearish order block in here. I covered all this. Then we have another level of distribution in here, or redistribution. Another level of redistribution, and finally sends it lower below the original consolidation and into the sell side liquidity that rests at the mean threshold on that daily bearish candle, which is a bullish order block. That's this level here. And it occurs on Tuesday. So the market rallies here. Now, do we trade higher into here or upset some of this for liquidity? We'll see. It's non-farm payroll. Wednesday's tomorrow, so we're trying not to do too much because it's already completed everything we would reasonably be expected to do. All right, 15-minute time frame for the euro. All I'm showing you is just a more detailed look on the lower time frame. It trades back down and finds support at that original consolidation and finds a rally off of that. Rebalances this small little fair value gap. We have a buy side liquidity pool resting right above there, and we have just a small little tiny little fair value gap right there. I left that in the chart so I can point to it without having any additional annotations because of the text here. Focus right there. If we keep seeing the dollar go lower, euro will want to go right up into here, which would take out buy side liquidity there. And the 5-minute chart for the daily log entry for euro dollar. Sell side liquidity pool, and 25 pips below that. Doesn't get to 25 pips, but I gave you that framework so you can see how, if you were expecting that, it just fell short of it before creating a turnaround here in the London Open kill zone. Support at the original consolidation during New York, rallies, institutional order flow entry drill here, rallies, and then noontime high of the day. It does go higher, but I'm framing the shortest time window to frame a daily range, which is midnight to noon New York time. The daily range would look like this: open, low of the day first, high of the day on the close. Power 3. Finally, British pound. We're just doing the 5-minute daily log entry for this pair. We have a buy sell liquidity pool here, and these levels here, I'll show you that again on the midweek review. This is a 1 hour imbalance, premium level, discount level. For homework, if you don't know what that is, go back and look at the charts and you'll see it. Sell side liquidity pool here at midnight, and it breaks lower into London Open kill zone, trades through the big figure. Okay, and here's your buy side liquidity pool here. So if we wait for it to come back down into the breaker, we have a low, the high, the lower low, the up close candle, and the high. That whole candle, that's your breaker, extended in time. Here it is, time, New York Open, price, breaker. It didn't rally here when it was a bull flag. It trades down into optimal trade entry, which is keyed off of this short-term swing low and this short-term swing high. Drops down into optimal trade entry and the big figure within New York Open. Consolidation in here, retraces one more time, order block, rallies. Institutional order flow, entry drill there, and then finally pushes into the close of the day. Consolidate a little bit more, but again, this pair, just don't want to touch it. I feel heartbroken in a way because I haven't done a whole lot with it, and this has always really been my favorite pair to trade, but for the last year, I have not had a whole lot of trades in this pair. All right, finally, I want to talk a little bit about S&P. Yesterday, I talked about some of the confusion I had for the new members coming in when I said I felt that it was problematic for stocks with the interest rate and some of the things I mentioned. I'm not going to repeat it all because it's already in video from the weekend. We don't want to sell short when we're in the deep end of the range. So the high to low, this would be like an oversold condition. If you had an indicator, like if I was plotting an indicator, you would clearly see you were oversold. You don't want to sell short when you're oversold. Okay, retail understands that much. And if I'm bearish, what I'm saying is if it gets to a premium or a premium PD array, then I'm interested in selling short. The imbalance here, sell side imbalance, buy side inefficiency, is defined with the premium high here at this candle's low. I mentioned this yesterday. And when we were trading up here, I said, I'm interested in seeing it go lower from here. So we use this going forward. Now, how do setups form, ICT? How can I take what you're saying and go into the chart and study and practice looking for things to form based on what you're saying, but still not be a signal service, still not put you in a live trade, still not do all the hand holding and get you so accustomed to me pointing it to you every single time, so that way you're codependent. That's a big, well, it's an important thing for me to balance, because I want you to learn, but I don't want you to be expecting me to lay it in your hands for you, because if I do that, it teaches, like I said, codependency, and I want you to be an independent thinker. I'm helping you with my experience, so that way you go in with the right idea, so you can start studying and looking for the things I'm teaching you. Even if it's hindsight, you're going to find that even with this example here, it's beneficial. So this was the level we wanted to see a reaction at, basically, because we had dropped from here down, rallied back up. We rebalanced all of this downside. Okay, all of this sell side delivery was rebalanced with buy side delivery. Look at the bodies of the candles here. You don't think that's respecting that? That very level I talked about. This is the S&P. This is one of the big boy markets, okay? We're not talking about Forex scam markets, guru scammers, Instagram guys. We're talking about this is a real professional market. Okay. This is a real institutionally traded market. Okay. There's a lot of liquidity in this market. And if Forex ever dies the death of one currency, I'm going to trade the S&P in the bond market. Okay. There's no reason why you guys should be sending me emails in fear. What happens if they end all the foreign currency? Well, okay. Nothing's going to happen except for I'm going to change my asset class. It's simple as that. And there's always going to be commodities. And it is what it is. You have to adapt. We had to adapt as traders from the 90s from open outcry pits where we had to call the broker, wait for the phone to ring, for them to pick up the phone. Then when they answered, they said, "Hey, hello, Lynn Waldock. How can I help you?" And you would say, well, for me, it would be H desk. Oh, 1 second. And they put you through. Then it rings again. The whole time the market's moving around. Okay, it's not waiting for you. H desk picks up. H desk, your account number. You give them the account number. Okay, then you give them your PIN. Okay, what can I do for you? If this was December contract, which it's March right now, you would say, I would like to sell 10 Christmas SPOOs at the market, or I'd like to sell 10 Christmas S&P at 3,900 or better. Good till canceled. That means the order stays open until I cancel it. And you give them a stop, you give them a target, and you say, okay, do you want to hold for your fill? Yes. Then you wait. He sends the order to the pit. You wait, and then all of a sudden he comes back. Okay, you have sold 10 Christmas SPOOs at 3,901 or whatever, if you, maybe 3,100 even, whatever your fill was, they give you that, and they give you a confirmation number or your order number, and that's it. You close and you hang the phone up. That's how we used to do it. You guys are spoiled. You pull up your smartphone, you click, 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 and it's done. Okay, it's instantaneous. It's right there. So don't be fearful of change. If they all go away and there's no wide selection of different countries' currencies, because it all goes under one currency, I don't personally think I'm going to be here for that. But if I am, I'm going to trade another market. It just won't be a currency. So there's nothing to worry about, folks. There's absolutely nothing to worry about. There's always going to be some kind of speculation. Okay, so if that speculation is available, it's going to use the things I'm teaching you. Or at least that's my belief and that's my faith. Okay, so there it is. But back to this level here. This level here is where we were outlining the idea, or I was outlining the idea yesterday, that I would like to see it sell off from there. Now, you may be wanting to see this type of move when I say that, but go into this area here, like I'm going to show you, and you'll see how it forms the setup. Here's your key level. So this red level here to this blue level. Why this blue level? Well, this is your fair value gap. This is the premium level of the fair value gap, which would act as a discount level now, because when price is up here, it's going to trade down to that. So in other words, this is just an area where a fair value gap would exist, and this would constitute an institutional order flow entry drill. Doesn't necessarily mean it's a buy. It just means that that's a good level to take profits if you're short. Where are you going to be short at? Look at the bodies of the candles respecting that level right there. Do you see this logic anywhere in supply and demand? No. They're going to be up here waiting for something up here. How about support and resistance? Nope. That ain't giving it to you either. It's this. Sell side imbalance, buy side inefficiency. The market remembers that level right there. Before it became electronic, the actual men that would make the market would utilize that level right there. That's why if you can go back in the old data, you'll still see these things happening then before electronic trading, because it's the same things. Only thing they've done, folks, is automated it. It's much more efficient now. People aren't lazily working. They're not missing the timing that would be appropriate. It's just perfectly streamlined now. And that's a good thing. That's a wonderful thing. Speed and efficiency is what we have been gifted with by them making changes, because they want it easier for them too. But once you understand what they do, they can't hide it. So we're just going to ride on their coattails and it's done. So let them make all the changes they want in the marketplace. It's just going to be making it easier for them to make money. And as long as they're making money, I'm making money. All right, so we're going to drop down into the 5-minute chart, wrap this video up. Here's that first touch into that level last night. As I was talking to you, we would see some selling at that level, and that's the premium level of that SIBI, okay, on that 4-hour chart. Market breaks down, creates an imbalance right there. Gets too far ahead of itself, comes right back up into the bearish order block right there with the fair value gap. Optimal trade entry here, 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 sell. Whoop, goes down. See this sell side imbalance, buy side inefficiency? See this candle's high right here? If the market trades up to that high or a little bit higher, you can be a seller. Boop. Sells off. Okay. If you were just taking the buy stops above here and using institutional order flow entry right there and just targeting that low from here to there, that is a trade that I would take personally. That is a trade that I personally would take. I would take this one as well, fair value gap, because the context of what I just outlined here, it starts to break down quickly. Well, what do you have here? Optimal trade entry. What time of day is this? London Open. Oh, this works there too. Yeah. Fair value gap, buy side liquidity right here. Optimal trade entry, sell off. Where are you going to target? Right there. That's enough. Then look what happens. Whoop. One more time, back up into the fair value gap. I know I shouldn't do the sound effects, but that's how I do it when I talk to my youngest son with these charts. You can hear me. I've been talking to him today. I'm stuck in that mood. I apologize. I'm not going to edit it out, so don't hiss and moan. So we have the sell side delivery here and attacking this low. So it creates offset distribution, and it trades into that daily fair value gap in the form of institutional order flow on the daily chart. So the time frame perspective is we are at institutional order flow entry drill as a buy right here. So if you were selling back here or here, here, or here, this is something you want to be aware of, because you want to definitely have something taken off, because otherwise you will ride through this. And it trades all the way up into that level again on the 4-hour. Look at the sensitivity there. Again, it's not supply and demand. It's not support and resistance. It's not Elliott wave. It's not any of that stuff. This is real institutional market theory, and then how price is delivered. Small little fair value gap here after this reaction. So if it trades there, we wait. We want to see what it's going to do. It hits it and rams it lower. Leaves this low in bounds. Well, when it trades back up to there, what would you expect to see happen? Rebalance and go lower. SIBI, institutional order flow entry drill. What do you aim for? Rejection block. See if you can get a piece below that. Does so right there. We also have a rejection block here. Goes below that, and then we get this run here and the rejection block there as well. Hits and sweeps it. It goes higher one more time. Right back to some random level over here. Something completely random. You would never expect something like this to occur. I'm being facetious, I know. Market trades lower. Sell side imbalance, buy side inefficiency. Trades back up. The body's respecting it, basically. Bearish order block, the highest up close candle, biggest beefy body candle. There's your order block. Optimal trade entry for the PM trend on Tuesday. See this dotted line right here? The reason why it's dotted at noon, this delineates the split of the daily range for SPOOs or S&P. So in the morning, you have a trend in the morning. Okay, so here's when the market opens up for stocks. And this is the mood that you would trade for the morning session. And then you go square, flat throughout lunch, between 11 o'clock and 1 o'clock in the afternoon. Then typically around 1:30, 2 o'clock, then the PM or afternoon trend forms for S&P. This is how I did my work every single day as an S&P trader. Every single day. PM trend creates the high, low, optimal trade entry, sells off. What's it aiming for? Liquidity below this low and this low, relative equal lows. And it should go a little bit lower than this one because this isn't enough for me. So I would expect this to go a little bit lower. How much lower? You have to go back to that 4-hour chart and then back to the daily chart and the things I mentioned. And we'll see how we get the rest of the week delivered. But you can see what I showed you is how you find where the setups will form. I'm never going to run out of setups. I'm never going to run out of yeast. Okay, this baker can find dough. Okay, and I'm teaching you how to do it. But you have to find the setups yourself that speak to you at these levels. So once you identify what you're looking for, then you just go in and you study that level and watch what forms. If your eye jumps to these little openings where the fair value gap is, then that's your setup. If yours is the optimal trade entry, that's the setup, that's yours. If it's the turtle soup, old highs, ran out to the level we expect, and you're selling short there, that's the highest form of courage and understanding, and you're going to get the best fills all the time. All of you want to do these, but in reality, you're willing to wait and want to do that. You want this because it's sexy. You want this because it's safe sex. Okay, not to be crude, but that's how most of you young men are thinking. You want this, but you're really going to wait for that. Over time, you're going to learn that is not a big deal, but you're going to learn to trust it over time. And it sells off and goes to offset distribution with the rejection block here, and then offset distribution here on that one. So notice what's occurred here. Today, the bias for SPOOs I gave you was what? Was it bullish? No, it was bearish. Off of what level? What was the framework? That 4-hour premium level on the SIBI. So it hits it here, sells off. It hits it here, sells off. And it hits the fair value gap after hitting there and then sells off. What pattern exists here on all the sell-offs? Everything I've talked about on each one of them. Optimal trade entry here, fair value gap, bearish order block. Optimal trade entry here, SIBI, institutional order flow entry drill. Optimal trade entry here, fair value gap, order block, sells off. Optimal trade entry here, fair value gap, order block, sells off. Fair value gap, context is at, it already hit this and it's going lower. Fair value gap here, displacement, imbalance, bearish order block, optimal trade entry, sells off. You see how they all start to dovetail? What you're going to find is a lot of the things that you're sweating and worrying about right now, what pattern should I look for? What if I pick this pattern and really I'm not going to do as well if I did this other pattern? Because I used to do that stuff too. It's all part of your development. Once you find something that your eye jumps to and you see easily, once you see that one pattern, learn everything else I'm giving you, but you're going to find that those things are going to complement and build up those setups around that particular pattern that you have grown closest to. The comfort level that you find in looking for the things I'm teaching you, I'm leaving that for you to discover because that is all personality based. I can't push you into a mold. I can't take you and say, okay, I have this big cookie cutter that's shaped like the ICT logo. Okay, and I'm going to mash you down, beat you flattened out, okay, and get rid of all the bad retail stuff in you, make you all flat, roll you across the counter, and I'm going to take this ICT logo cookie cutter and mash it into you. And then here you are, you're shaped in the form that I want you to be in. That doesn't work, okay? It does not work with me. It will not work with any other teacher or mentor for any other thing, okay? Not just limited to trading. To be successful, you have to bring your own personality into this. You have to bring that. And that's why in the first beginning months of this mentorship, really the first half, it's all about figuring out how you're going to derail yourself. And if you can figure out where those problem areas are and then replace them with positive reinforcements and things that help you cope with learning more things and not derail yourself, you will replace those bad habits and character flaws, because we all have them, folks. I still have character flaws. I don't get the best exits. There's one for you. So if you think about the first half of this mentorship and understand that it's pruning all of the things that's going to be stealing your ability to succeed and grow faster. Not that I'm trying to speed you along, but it's going to impede your growth if you keep these bad habits. And if you keep these bad habits and you go to live trading, you are going to find out how painful they are. You need to replace them while you're learning. Because if you replace them while you're learning with no trading with money, no trading with a demo, you're going to find that trading is easy. It's absolutely easy, but it's impossible. Okay? Trading is the most cleverly disguised impossibility. It's easy. It's so easy until you put live funds in. And then all of a sudden, you're wrestling with somebody. And it's you. But you're going to swear up and down, it's that evil broker. It's those market makers. They're doing it to me. They're doing whatever they're doing, but they don't know about you or your order. You're just doing things that you shouldn't be doing if you're getting stopped out all the time or losing. So there is this process that you're submitting to, and once you submit to it, you'll start seeing these things in other markets and not just Forex. You can make an enormous fortune trading just the S&P and never touch a currency ever again. You don't need to look at the dollar index. You don't need to look at, 3 markets to find out a trade. You can literally just trade the S&P market against the bond market. That's like your barometer. Okay. And it tells you whether the trades are going to be big or just something small. And you'll learn all about that. In this mentorship, I'll teach you all that. But I wanted to take the time to revisit the difference between what I said on the weekend, where I said, it's problematic and I would really look for weakness unless it trades above this old high. And when I was looking at the chart for the S&P. But when we went into yesterday's analysis, I went right in there and told you, okay, because there was confusion, the new students were saying, hey, look, I expected this to go lower. And look what it did. Yeah, it went where we want to see it. We want to see it trade up to a premium. It's got to get overbought. Okay, let me speak to you in that term because many of you probably understand that. When it's up here, it's overbought. When it's up here, it's overbought. When it's over here, it's overbought. That's the ideal areas for you to sell short. But how do you frame overbought? I'm not pulling up an indicator. I'm putting this red line here on the chart. And anytime it touches that level, that's when institutions would see it's overbought. And then that's where they want to sell because they know it's at a premium price. It's about as far as it's going to go, is what I'm saying. And look at your chart. All you have to do is look it up and pull up your chart and you'll see what I just showed you yesterday and talked about before it happened. Here we are. What patterns are here? The very ones I'm teaching you. This is the reason why I say don't worry about missing moves. These things are occurring in every other market right now. It's happening in stocks. It's happening in the bond market. It's happening in currency futures. It's happening in commodities. Forex. Come on now. You can't be in everything at all times. So that's the reason why I tell you just focus on the euro dollar and focus on the British pound and the dollar. Because I'm teaching you how to stick to one area and become an expert. You're being an expert in price action. I'm not making you experts of euro dollar. I'm not making you experts of or pound versus US dollar. And I'm not making you dollar experts. Okay. I'm not making you Forex experts either. I'm teaching you how to read price. So that way, when our time together finally does end, and I don't know how that would be, but if it ends for whatever reason, however it ends, you're going to be okay. So that way you'll be able to go out and find setups, and no matter what asset class you trade in, then there it is. You have it. But these things repeat. If I would have hid this chart name or the market, basically what this market is, if I would have hid it from you and hid this price axis over here, and I showed you that only the people that were following S&P would recognize this chart. Only those individuals. But you would have been trying to figure out what currency is this? This is probably that Swiss franc or the Japanese yen, because it's not a pair I would normally talk about. And because I'm not talking about it, you probably aren't looking at it either. So you're thinking, okay, what currency is this? Instead of going through, the logic of learning and showing what it is I'm showing you here and retaining that, you're going to be trying to figure out what currency it was. And it's not a currency. It's the Standard & Poor's futures. That's it. This market here is highly highly traded. And it doesn't have a whole lot of manipulation like Forex does. Okay? Just like the bond market doesn't have a whole lot of manipulation in it either. Now, you hear these guys talk about how they use a 2-pip stop loss in Forex, and they're liars. There's $1 million of my money if you can do 30 days trading every single day, use nothing more than a 2-pip stop loss with a live account. Not empty for crap. Okay, I put this out there. Not one person can do it because it doesn't happen, folks. Listen, I'm really good, and I can't trade with a 2-pip stop loss. Okay, I can't do it. Even with a 1-minute chart, I can't do it because I know the broker, they have the luxury of opening up that spread. They can do that. That's legal, and that's why these yahoos that are 20-year-olds, they're talking that stuff. They're liars. They have no idea what's going on. They have no idea. Period. But now take me over to the bond market. Yeah, I can use less than 5 ticks in that market. I can trade with a 3-tick stop loss in that market. Okay, those markets are really, really efficient. They're really efficient. They don't have a whole lot of tomfoolery in them. Okay, but they're very boring. They're very, very, very boring. And for some of you that eventually will get old, like I'm going to eventually become 50 here in another year or so, and I can feel my body talking to me. Like it's telling me all about it. Okay. So I know that I'm probably not going to be able to weather some of the excitement that usually comes into the markets on the Forex level. And I might want to go back to something that's a little bit more tamer. And that might be like this market here. I'll go back to where I started, and the bond market, because they're slower. And you can still make lots of money doing that. It's just, I like when these big moves occur in the Forex, I just like it. It's fun to be a part of. I don't like carnival rides, like roller coasters and things like that, but I like to be a part of that run when it happens because it feels good. And maybe this is a market, like I was mentioning, and I think I started to say it, but I didn't really complete my thought on it the other day. You know, a lot of students come in here thinking they're going to just learn Forex, and they discover that they learn how to do all kinds of trading, not just Forex. Because what I'm teaching you is price action mastery, not Forex. I'm not teaching you to be a Forex trader. I'm just teaching you price with my favorite markets at the time, which is euro, pound, dollar, and trading it against the dollar. That's my favorite markets right now. Will it be my favorite markets 5 years from now, 10 years from now? I don't know. It could change and make me go back to this market here, which I'm showing you. This is the same stuff I was doing back in the 90s. It's been just like this all this whole time. So there's no reason for you to worry, okay? Stop worrying and stop sending emails. What happens if it goes to one world currency? What happens if this woman's report is true and they're trying to do this and they're trying to do that? I have a different opinion about where I'm going to be if that happens, okay? I'm just going to leave it at that. I don't think I'm going to be around for that. So if it happens, then I'll adapt and do what I'm showing you here. Isn't this the same kind of stuff I'm teaching you with Forex? Absolutely. It's all time delivered, and it's all relative to price. So time and price still dictates everything. There's no reason for any anxiety. There's no reason to rush. You need to know what you're doing before you put in a live trade. Period. And you need to be bored with it before you ever put a live trade on. If you're not bored and see ridiculous levels of consistency, I mean, you know this is the way it's going to be. And that doesn't sound like the books teach. Okay, these other authors out there, they're going to teach you to accept, to believe that you're going to get it wrong more than right, but use money management and you'll survive. I don't want to do anything like that. Who wants to do that? That's like, look, go into this Lions exhibit at the zoo, wrapped in steaks, and run really fast. Okay, you're probably going to die. You're probably going to lose some limbs. But hey, look at the excitement factor of maybe surviving it. Think about it. I mean, it's nonsense. That's what these people sold me in these books that I own. Okay, that's the nonsense that is still pushed on these people that come into this industry. Okay, they're brand new. They're like, man, this is incredible. Like, I really could survive this onslaught of a lion chewing me up. Because that's what they're saying. The books are saying, hey, look, you have a really, really poor chance of making money. But on the slim chance that you do get lucky and you do survive, you could make money. And you can credit this book for doing so. So I don't want those types of odds. I don't like that. Okay. Clearly, you've seen that I like to look for things that are a little bit more likely. They're not guaranteed. They're not 100%. But boy, oh boy, it's totally different from the things that I learned in books. Okay. It's opposite to that. So hopefully you got something out of this one today, and I will be back tomorrow for a midweek review. Just know that we're going to be doing more of this style where I'm going in, I'm teaching you theory, I'm teaching you foundational studies that I will build on that leads to being able to go into the marketplace and find where the setups are. March 9th is when you have to have your month 2 payment to me. Okay, if you don't have it to me by that date, on March 10th, I'm removing everyone that has not made that month 2 payment. You won't have access to month 1. Okay, so I have people emailing us, and my staff's telling me that I have to talk about it right now because it's a lot of you doing it. Just like the agreement said, you lose access. If you don't make month 2 payment, you don't have access to the things that you are watching in month 1 right now. Okay, it's just like Netflix. You have to pay to play. And if you don't pay, you can't play. So on March 10th, you're going to notice that your videos will take you to directories that are very specifically named. Okay. We have user groups that have been broken down into, so each member is part of a group, and that watermark is for that. It took us a lot of time to get it like this. So that way it's going to help me find the leakers, and then out the door you'll go. But if you notice that you have an issue with your videos, some of you say, I can't watch this video or that video. If it would be a wonderful help to my staff when we get to the 10th of March, you're going to see your videos will be in very specific directories. And if you tell us that you have an issue with your video, if you would please include that directory, or actually just send us the link. Okay, just copy the link in your browser and send that very link to us if it doesn't open for you. Okay, that'll help us track it down, because we're doing so many directories for the files now because of different user groups and such. We may make an error in putting a video that would be otherwise part of another user group in the wrong directory. Okay, so I anticipate that occurring. I don't think it will happen, but if it does, it'll help us correct it quickly. Okay, and also stop sending any technical issues through the ICT Mentorship Inquiries email. If you're already a member here, you don't use ICT Mentorship Inquiries email ever again. Okay, you don't do it. You only email me at innercircletrader@gmail.com. Okay, I'm using the ICT Mentorship Inquiries at Gmail for people that are giving me videos that are being leaked, and I'm working with them to find out. I got 3 people on Instagram that are pushing out 2021 videos, and I have people giving them to me, so I'm weeding them out. I'm gonna get you. Until I talk to you tomorrow, be safe.